Hype Man, Raj Nation, the GOAT to market. From Hype HQ in Chicago, Illinois, Startup Hype Man presents the GOAT to Market Show. What's up, everyone? I am your host, Raj Nation, the founder and chief pitch artist of Startup Hype Man. This podcast is where we bring you founders, company leaders, and creatives who are building it, who are doing it, who have been there and done that. And they pull back the curtain on their go-to-market strategies so that you can build a venture that you love and become the GOAT of your industry. Want first listen on episodes before anyone else? Subscribe to our newsletter at startuphypeman.com. You will get alerts every Sunday morning when we release new episodes. All right, let's hear how today's guest is becoming the GOAT. What's up, GOATs? It's your host, Raj Nation, here with a special treat this week on the GOAT to Market Show. As many of you know, in addition to running Startup Hype Man, I'm also the chapter director at Startup Grind Chicago. And as we've done on the podcast feed before, we've shared the replays of the interviews, the fireside chats that I've had at different Startup Grind Chicago events. Today, we've got the replay of my interview with the co-founder and managing partner of Supply Change Capital, Shayna Harris. Supply Change Capital invests in the future of food through the lens of culture and climate. Shayna talked about Supply Change's investment thesis, but the majority of our conversation was actually around how to land investor meetings. She gives her advice, her tips, her tricks, the do's, the don'ts, the red flags, the beige flags, and the green flags. She also touches on something that I think not enough founders understand, and that's the flow of capital from the lens of a venture capitalist. The more you can understand how money moves, the more successful you're going to be in your fundraise process. This interview was originally conducted in June of 2024 at the Cressa Chicago office. Cressa is a commercial real estate firm helping startups scale up through the right office solutions. Here now is my conversation with Shayna Harris from Supply Change Capital, live from Startup Grind Chicago. The Startup Grind tradition is that we welcome our guest as if it is Beyonce just taking the stage. So,
I like that.
Ladies and gentlemen, get up out of your seat. For the one, the only, from Supply Change Capital, Shayna Harris!
Well, thank you. I wasn't expecting that. So, and I do love Beyonce.
So the album Lemonade, what was that like?
Well, I have to say, Cowboy Carter is on repeat in my house.
Oh, you're a Cowboy Carter fan.
Major.
I'm not in on Beyonce's country tilt.
Major. It's not all country.
Okay. Well,
you got to give it
I'll
a
tell you
listen
this.
through. Although Dolly, I mean, you can't deny Dolly.
I did not love her remaking Jolene, but.
Do you know who endorsed that? Dolly herself.
But wait.
But continue.
But wait, I did not. I'm not saying I did. I'm just saying I did not love her rendition of it.
Oh,
but
okay.
I love that she flipped the narrative of it, of being the person in power in the story, not the person who's helpless in the story.
Yep.
As a storyteller, I appreciated that. So Beyonce stuff aside, Shayna, you're big into food and investing in food and climate and the things that are related to those aspects, but you yourself are a foodie.
I am.
Favorite restaurant or cuisine?
Oh my God, that is hard. Well, Mexican, 100%.
Okay.
I love Oaxacan food, so from southern Mexico. My husband's Mexican, so we spent a lot of time there.
All right.
My favorite place to eat is my mother-in-law's house.
Ah, good answer.
And she's not going to watch this, so I'm definitely not saying it for her.
Are you big into Rick Bayless's stuff? Is Oaxacan, right?
I love it. He does like regional cuisine from all over Mexico. I love his restaurants too. Yeah.
Nice. One of the things that when I was doing some research for this conversation, because we've never met before, right?
I mean I've seen you at events, but no,
I don't think we've ever talked before. So hi.
Hello. Nice to meet you.
One of the things the lead thing you write in your LinkedIn profile is, I believe in the quiet wisdom of what surrounds us. What does that mean to you?
It means to listen and observe. And I think in this space, in the startup and venture capital space, the best founders do that really well, and the best investors do that really well. But there's a lot of folks that take up a lot of air space. But I think if you're observing and you're listening and you're taking in the data, qualitative and quantitative data, that's kind of where the breakthrough thinking happens.
Do you think, well, based on what you just said, I think there's not enough listening, but why do you think there is a challenge with listening and people wanting to talk before listening?
Oof, that's a deep one. I think it stems from insecurity, if we're going to talk about psychology. If you think about people in your life, and a lot of times they're startup founders that will talk a lot. And I mean, I will do this too at times. If I'm feeling insecure in a situation or unsure, I'll tend to overemphasize the facts. I'm underestimated often as a female investor. And so I'm in rooms where I'm having to recite and memorize, the facts to make the case. And it's, sometimes it really just stems from insecurity, I think. I would say that about politicians. I say that about business leaders. And I think it happens to all of us. Yeah. But it's just remembering that there's sometimes power in being quiet and the pause. They teach you, you probably know this, you're a great speaker, they teach you the dramatic pause. You're trying to galvanize a room and gather room. So I think it's just remembering that. There's a lot of power in observation and taking in what's around you. That was actually a colleague of mine from business school that taught me that concept. It really made me think about it.
Anyone here ever had the moment where you feel like you're talking a mile a minute because you're nervous or scared in that moment or insecure? Yeah, I think we've all been there. But you're right, that slowing down, the dramatic pause, maybe getting a little bit softer, people start to lean in. And then when they're in, you bring it back up. And then you capture them because now they're leaning in. And now you nail your point.
And I think this is a very good thing to think about when you're a founder and you're pitching your idea a lot. And we can get to this when we talk about like how to do pitches that don't suck, which you spend a lot of time on, and I see a lot of pitches. It's the oftentimes the founders that really captivate me are the ones that are measured in how they're thinking and what they're sharing. Because otherwise, sometimes it could just be like you're at the receiving end of a fire hose of information. It's just hard to follow. And that insecurity that's causing you to take up a lot of space and talk a lot and say all the facts, you start to lose the other party. And I'm just sharing this because I will do this sometimes too, and I have to catch myself. And also surround yourself with good people that can remind you when you're doing it.
Yeah.
So.
Your career, you've worked in Mexico, you've worked in, I think, Brazil, right? Ivory Coast or Côte d'Ivoire, right? Can you just kind of generally walk us through your career? I know that's asking a lot in a single question, but walk us through, what took you to each of these places, and what would you say was kind of your big takeaway from each place?
Yeah. Well, so the through line is I've always been very passionate about the food system and food systems change. And that comes from my family. So my grandfather was a farmer, and we grew up with the story of how he couldn't make it on his farm. He immigrated to the U.S. from Europe. That was one side of the family. The other side of the family is stories of immigrating from Russia during the Bolshevik Revolution and then coming to the U.S. to the Great Depression. So saving and pickling and cherishing every part of the animal and the vegetable that you're using. So I just grew up around this ethos for food. So I'm very passionate about the food system. And then when I was in college, I knew I wanted to have a career of some kind of impact or greater purpose. And I kept hearing that the world's poor are farmers, and many of the world's farmers can't feed themselves when you think of the majority of small farmers around the world. And it just really stuck with me. So that's kind of how it initially clicked. I did work for many years in global supply chains and tropical commodities, hence being in Mexico and Brazil and Côte d'Ivoire when you're thinking about coffee and cocoa. And you're just thinking about those types of crops. They play a huge role in our global food system and in our economies and in the economies of the country that are producing them. But there's a lot of inequities in that system. And what I saw early on was kind of an arbitrage opportunity for social impact, which was that, 2 decades ago, large food companies were trying to figure out how to get a consistent quality of the raw materials coming into the businesses and didn't really know where they were coming from. And so I started to play that bridging role. And it led me actually to go in-house to work for Mars when Mars was thinking about first their cocoa supply chain and then the next 19 commodities that they needed to figure out. where does this come from? How do we contract better with farmers? How do we bring better quality and stability to our business? And now today, if you read, the Wall Street Journal or other business articles, you see commodity prices are incredibly unstable because of global climate change and labor instability, et cetera. So it's just I've always been interested in that food system and how do you find the commonality so that you can have the best social and business outcome. It's not always congruent, but I do think in more cases than not it can be. So that is what caused me to have a very global career for the first part of my career. And then I got really impatient with how long it takes some of these changes on a really big scale. And I wanted to move faster, and I love building things. And I realized I was doing that over and over again, but inside of large organizations. So I ended up joining a startup here called Farmer's Fridge. Mm-hmm. And then the last decade of my career has been very focused here. And how many of you have heard of Farmer's Fridge and have had it? So it's for those of you that haven't, it's a company that sells fresh food out of kiosks and in jar format. And essentially at the airport, the principle is to kind of flip upside down the process of creating fresh food so you can provide it at a more affordable price. So hospitals, universities, places where people really need fresh food. So that was kind of the original idea. Now, the company's just figured out how to make very high quality fresh food at scale at a more affordable price so you can get it at Target and Jewel, et cetera. But I was the chief operating officer at that business, and then I led revenue. So I was there for 4 years, from the seed to the Series C round of funding. I loved building. I loved it. And I bump into people from Farmer's Fridge all the time. This morning I bumped into a former colleague, and I just find the whole process of building to be, I love how every day is different and your context changing and your problem solving. So it was amazing to do that work. And then somebody was asking me, well, then how did you get into investing? And with Farmer's Fridge, again, this question was, how do you bring about change in the food system by thinking differently about how you're producing something? And what I saw along the way as we were raising venture capital and I was more exposed to that world was that there was really an opportunity for folks to be involved in the investing side, particularly early stage, that have actually operated food companies and been kind of in that part of the world. I also cannot watch some of the shows on Netflix about startups because there were a lot of those experiences early on raising capital. It just is a little, frustrating to see. I'm like, I don't really need to relive it. So when I left Farmer's Fridge, I thought I was going to start a company. I was really ready to take that leap myself. And it was COVID. So there was just a lot of different dynamics and conversations happening. And as I started to learn more about the VC and PE landscape and the value of an operator on that side of the table, someone who had built companies or run big teams and things like that, I realized that there actually could be an opportunity to be on the investment side. So there's a longer story behind that. But again, it was really pulling the thread around impact because I kept thinking, okay, who's allocating capital? Who's receiving capital? It certainly is typically not folks that look like me, and it also women and a lot of other people with a lot of other backgrounds. And also, I think that there's a competitive advantage if you really have understood the industry and worked in the industry to think about the opportunities for capital allocation. So if you just take this thread on commodities, 20 years ago we were looking at risk management in that sector, and then what do the commodities of the future look like? How do you rethink that trade? And so essentially what we were doing was thinking decades ahead, and that's what you have to be able to do as an investor. So it's kind of taking some of that way of being and thinking to applying it to capital allocation.
So you start supply chain in 2020. Mm-hmm. It's not necessarily a supply chain company, though it has that similar sort of alliteration to it. But there are things I think that impact the supply chain in it. Mm-hmm. Can you kind of give everyone the overview of the firm and the thesis of the fund?
Yeah, so we invest in technologies to transform the food system. So there's a lot of technology behind what got this water bottle here and the food on the table. There's tons of, when you think of the machinery and you think of the software and you think of the data behind the system and you think of the science and R&D. So that's really what we focus on. There's 4 areas we look at. So we look at technology for the environment, so thinking about solutions for wastewater and soil, and that very much touches the climate. We think about technologies around health, and I don't know if any of you are working on these solutions, but a lot of opportunities to think about all the underserved consumers or citizens in the US and how we think about like feeding ourselves well during our busy day and busy lives, and there's ways that technology can serve that. We look at novel ingredients, which is basically what are the types of replacements, what's going to be next in our foods if it's not the thing that we've been having traditionally for the last 100 years in our industrialized food system. And then we do look at supply chain and value chain. So different ways to think about production on farm, manufacturing, logistics, how things move around. And really the focus is that in order to think about the future of food and have returns investing in the future of food, you have to be investing in companies that are going to be resilient to weather all the changes we're going to be seeing in our environment and our health. And so sustainability and impact is very much at the core of what we do, although we don't say we're impact investors. But I don't think you can have a thesis when you think about the future of food systems and not think about those factors.
So as we start to think about how a founder can get a meeting with an investor like yourself or whomever it might be, I think the right starting point for this is really understanding who should be reaching out in the first place. Every fund, or most funds, if not every fund, is very thesis driven. I'm going to imagine you get people who still even are outside of your thesis who are still like, but I'm the one, right? Please just trust me. I'm the one who you should be taking a look at regardless. So that's one way to look at it. But I think the other way is, can you give your lens on what kinds of companies in the first place should be trying to raise investor capital versus not?
Yeah, that's a great question. So investors are basically evaluating your company for a return, right? And if you're in venture capital, you're looking at the minimum at a 10x return, and many are looking for multiples much higher of that. And are you familiar with this concept of portfolio construction? Some are, some aren't. So I'll explain it. So basically, when you're an early stage venture capital investor, you want to have a number of companies in your portfolio. So some will say 30, 25, 40, there's a range. But you want to have a variety of companies in your portfolio because the hypothesis is that just a few of those will have the exits required to return your fund. Because as investors, we have a fiduciary responsibility to return capital to our investors. So that's the starting point, is like when you hear VCs talk about hypergrowth, that is the model. So if already you're not interested in hypergrowth, don't raise venture capital. It's like rule number one, because that's the incentive system, right? And venture capital can be an amazing tool. I mean, it's fueled game-changing technologies. Like, name one. I know you're thinking a lot about what's the technology that was VC-backed that changed everyone's lives. Stripe. There you go. So like in our everyday life, there are examples, fintech and the way we transport goods. I mean, all sorts of things, right? So it plays a really exciting role in society, and it is really not for most entrepreneurs, I would say, which is maybe a hot take or a controversial take, but I think it's the truth. And I do think that some founders who want to create a great business, but it doesn't have to be a hockey stick, if you know what that means in terms of growth type of business, will take VC and then get frustrated that there's certain expectations from investors. So I think it's the upfront knowing what type of capital you should be taking, and VC isn't for every business. It's probably not for most businesses.
Can you, there's something you said in there that I just want to make sure is understood broadly, because I don't think it is actually understood broadly, and that is, you said you have an obligation to your investors. So can you explain the flow of money and how that works, and then how that ultimately impacts a founder's decision and why they might get frustrated,
Yeah, so that is fascinating. And that's one of the reasons I was like, ooh, I think that VC could actually be a very powerful place to be in the food system as we start to think about change. So essentially, we have what are called limited partners, or LPs, that invest in us as the venture capitalists, and we are the general partners of our fund. So the LPs invest in GPs, and then we invest in founders. So some jargon there.
It's like a Wheel of Fortune puzzle of consonants.
Right. Just LP, GP to founder. And the LPs can be anybody from a family that sold a business. It could be the founder of Stripe. It could be, somebody that sold the family business they've had for a generation, or 4 generations. I don't know. It could be, so that's called family office money, when families start, investing their money. And families typically will think about venture capital as a part of what they invest in, but they'll also invest in stocks and public markets and things like that. It could be an institution. The state of Illinois is a great investor in the Illinois ecosystem through the Illinois Growth and Innovation Fund. There are banks that invest.
There are governments. Like sovereign wealth funds.
There are registered investment agents, RIAs, that basically will work on behalf of other individuals. Universities are a big, endowments. like we're hearing about a lot in the news lately, that's a big source of investment dollars. So we, as the GPs, are also raising money. So we very much understand, what you're going through. We're raising different amounts of money, and oftentimes, so for early stage investors, so our first fund was a $40 million vehicle. So we raised $40 million, and then we're investing in 25 companies out of that fund. There are firms that go out and raise $1 billion, just depending on the scale, and they're usually probably investing much later stage because they have a lot more dollars to put at work. So, and our fundraising cycle typically lasts, 6 to 24 months, depending on who you are. So it's it's long. It's longer than a startup generally.
More from my conversation with Shayna Harris in just a minute. But first, if you're going to get in front of someone like Shayna or another investor, and you're hoping to get investment from them, you got to make sure your technology is up to par. And if you're not a technical founder yourself, then you've got to have the right partner. But not just any partner, not just a good partner. You want the GOAT of software development as your partner, and the GOAT is Akava. Here's the deal. I've seen too many startups get screwed over by offshore or budget dev shops. What do? Those providers are order takers. They do the bare minimum, and that often means getting software back that has gaping holes in it, or being forced to pay hidden release fees to claim ownership of your code. But then there's Akava. They actually build strategically for scale from day one. They help you make product decisions in the process of developing your software, and they give you full ownership of your code by default. And they've got a killer offer for you. In the name of partnership, they're giving out to the Startup Hype Man community a You Call It code review. What's a You Call It code review? Well, for those who qualify, Akava will review the most critical parts of your code so you can see exactly what your tech needs to launch or scale. And they'll do this completely free, and then you call it from there. So you can get that review from them, and then if you're like, okay, great, I can take it from here on my own, you call it. If you want to get Akava's dev help, you call it. If you want their advice but you want to take it somewhere else, you call it. It's an unbeatable offer. No one else on the market is putting this out there for the startup community. Are you ready for a You Call It code review? Are you ready to get goated? Head to akava.io. That's akava.io, akava.io. Fill out their inquiry form and tell them Startup Hype Man sent you.
So you have the LP to the GP to the founder. Mm-hmm. How much say does the LP have in the investment decision?
It probably depends on the governing documents for that organization. For us, nothing. So my co-founder and I are the investment committee. So I have a business partner who's based in Los Angeles, and she comes from she's an aerospace engineer, kind of deep tech turned investor for the last decade. So we bring different skills to the table. And so we're the investment committee, the two of us. But it really depends on the organization. Our LPs invested in us because they believe in the thesis and they believe in our team and our ability to execute it. So it really depends on what the arrangement is. Some organizations have an investment committee, and some of the LPs might be on that investment committee, and they're reviewing the investments.
The founder is trying to get a meeting. There are a few different avenues for this. Mm-hmm. I think the most well-known would be get a warm intro, send a cold email, maybe a cold DM, submit through the inquiry form on the website. How would you rank those in terms of effectiveness or even just preference?
I think it's going to depend on the investor you talk to. We love submissions coming through our website. We have that form there because we want to give everybody a chance to let us know about them. And of our 18 investments out of Fund 1, 3 came through cold inbounds. Nice. So we are cool with cold inbounds. We are also like warm intros. If there are investors in the ecosystem or other founders, increasingly, as we're growing as a firm, other founders are sending founders to us. We like that because these are folks we know and trust in the ecosystem that understand our investment thesis. Maybe they've worked with us before. So that's really great too. We meet founders at conferences. There's all different ways to do this. We have a full-time investment associate, and she's kind of like air traffic control. She's awesome. So first line of defense on all the deals coming into us. Even if we give a warm intro, we still say fill out our intake form. We usually won't take a call. And that's very rare. Most VCs don't do that. But the reason we do is we're trying to address bias in the process. There's a lot of bias in this investment process. And we think bias is bad for two reasons. One, we think it prevents the generation of wealth for America. And two, you're going to miss out on great investment opportunities because you're just pattern matching and looking for people like you. There's a lot of research on that. So it's really important for us that whether it's a warm intro, cold intro, conference, whatever the meeting vehicle is, send information through our submission form, because then we can compare apples to apples, the information. Like, here's everyone that came in this week, here's who's bubbling to the top. Right?
What are the things you've seen that have just been like absolute no-nos in trying to get on your radar?
Okay, well, so we get, I'm trying to buy land in Nigeria to grow some crops. I'm like, cool, or it could have been in Iowa, but for some reason we've gotten a couple in Nigeria. And I'm like, well, we don't invest in land, right? So that's like something, it's like, just, it's food. But the type of investment they're making, like, we're not going to do that type of investment. We've gotten real estate, which is just like kind of out of scope. We've gotten some things that have nothing to do with food and agriculture, like software for, like workforce software, but it has nothing to do with our industry. So it's either something that's like not the asset class we invest in, not the geography we invest in, or not even thematically what we look at. And what's silly about that is, like, you just wasted a whole bunch of time filling out our intake form, because we are very clear on our website about what we invest in. Like, I don't know, you might have looked at the website.
Yeah.
I hope it's very clear. It's like, this is technology for food and ag, and that is what we're focused on. So yeah, we get a lot of stuff. And I actually don't see as much of it anymore because our associate looks at what comes in. But yeah, we get some that I'm like, I don't think you looked at our website.
Well, I think, coming back to your earlier point about the flow of money, like, for the person who thinks, no, I can be the one to, like, break thesis in a good way, you are now not upholding your fiduciary duty to the person and to people investing in you if you were to break thesis. Even if you like the company, you can't do that,
exactly.
right?
And we do have a wide mandate, even though it's food and agriculture. Food is a $1 trillion industry. It employs up to half of the citizens of the world when you think about agriculture and all of the different ways that food touches us. This is a massive industry. And so we recently looked at a company that is focused on a different way of providing health care for frontline workers in agriculture and food processing. So we love looking at things that are going to improve the social and working conditions for workers in our industry, because we know traditionally it's a very difficult industry to work in. And if you look at where all the growth is coming in our country over the next few decades, it's from immigrants, mostly from Latin America. That is we care about this population, and it's also a huge investment opportunity. So I think the way that we view demographic growth, that type of change, the trends, like, we have a huge aperture to invest against. But it's interesting. I'm sure many of you who are founders have felt misunderstood by investors before. Sometimes we'll feel misunderstood by LPs because we'll talk about the opportunity to invest in the technology powering our food system, and we'll get the reply that's too niche, right? So yes, we box the world around the food system, but we've done biotech investments, we do software and marketplace, we've done software hardware. We really take a wide aperture of types of technologies. And so I'd say one of the other lessons we learned, which may be helpful for you as you're raising, is you're not going to convince the non-believers. So if in the first call we're getting the feedback like, this is like way too niche, previously we were trying to like convert the unconvertible, but now it's just like, no, we know that there's other people out there that understand what we do. So I think that's the same thing for founders too. Sometimes I see, like, we'll give a no and we really mean this is not going to be a fit, and the founder keeps coming back. And I just want to be like, I really don't want you to waste your energy. Focus where there's energy for what you're doing and build those relationships.
The process of getting that meeting, what looks like what's a well filled out application on your website? Let's start there. What does that look like?
Great question. Really good deck, 10 to 15 slides, very clear why you're doing what you're doing. And it's the like, what's the 10-slide deck guy?
Guy Kawasaki.
Yeah, Kawasaki. Yeah. It literally just use that. It's like, what's the problem? Why am I solving it? What's the market size? Why is my solution different? Because I just need an easy narrative to follow. I'm flipping through in 2 minutes. So that's important. Then I'm like, if the deck is like, there's somewhat compelling or some different insight in here, I'm looking at the information you sent us, which is about your founding team, the market opportunity. Do you have any revenue? Is there any kind of bigger, kind of greater impact, which is important for us as well. So, and we're like on our website, we say this is how we evaluate you. So, it's pretty clear. But the first thing we're going to look at is the deck. Because you think about how much information we're all getting on a daily basis. We talked about the mental load and drain and fatigue of being a knowledge worker. So we being able to follow that narrative is really helpful. But then when you get to the call, I do not want to go through a deck. I would like to have a conversation. And we find this with our fundraising as well, as we're finding folks just they want to have conversations. You may pull something up at some point to illustrate a point, but it is really hard on Zoom to meet you for the first time and follow a narrative when a deck is up. I can't really see your face. You start just tuning out. And I think this is pretty much across the board. I know people say like different investors have different preferences. I think in-person pitches are really effective and they can be with slides, but like I don't even think you need slides. Like I think your approach is great. And I would say for that first call, having a conversation is important. We will be prepared. So generally, like someone in our team will have created a one-pager about the company before we have a team call. We're kind of all briefed. So, and we have notes we're sharing. So we're trying to be as up to speed as we can before the call. Some investors may not have looked at your materials at all. So you may be starting from zero. So I think you want to ask at the beginning, like if you've talked to someone on their team before. I know I've previously talked to Rachel, who's our associate. Shayna and Nora May, where do you want me to start? That's a great starting point. If you've already talked to someone on the team and now you're talking to the partners. If you haven't talked to anybody on the team, I sent some materials in. I'm not sure if you got a chance to look at them. If not, no worries at all. Where should I start? Just always get that orientation. You should also ask questions of the person you're trying to raise money from. Like understand what stage they typically invest in, what areas they're excited about right now, what are some of their recent investments. You can probably look that up on PitchBook or Crunchbase. Do a little bit of homework ahead of time, even if it's like 5 minutes Googling, okay, LinkedIn got it, so that you can ask questions of them on the call and understand what they're excited about. Try to have some kind of a connection. If it's Zoom, again, because it's a lot of times I think these meetings are happening now, the first meetings are happening in Zoom. So express you've done a little bit of background, not too much that it feels weird, but just enough, and ask them, about their investment mandate and what their check size and what their process typically looks like, because it's different for every VC. And I would say if you're asking those questions, it's very valuable data. You should have your own database on like Google Sheets or Airtable where you're then recording what people told you so you can remember, because it'll be really good for you later to go back to, and also you can share that with other founders, like the give forward. So we actually have a database on our blog, which I think we need to make a little more obvious through our website too. But we send this to founders where we've passed, and we say, we think what you're doing is amazing, it's not a fit for us, but here is a list of 100 investors that invest in food tech in all the stages, and you can sort this Airtable, because it's what we've learned about other investors in the ecosystem. If we have that information, why not share it? It could be a really great match. There's a lot of information asymmetry in our industry. It's very hard. It's a people-to-people industry. It's just very hard to know what's out there. There's a ton of folks that have tried to create the marketplaces. You can get some stuff on PitchBook, but not a lot of super early stage information. So I think the more that, if you're spending the time to have these conversations and they're a half hour each, and if you're pitching, I don't know how many of them you're having, take the notes, capture the information for yourself at the very least, but share it with your founder friends too. I think it could be really valuable. There might even be a database about where founders are all putting their information. If there's not, there should be.
Let's say I know about that.
Right? I mean, there should be it's like, what's the repository of here's what I learned.
Yeah.
And here's how we can help each other.
We've got the rest of my conversation with Shayna Harris right around the corner. But first, let's talk about your marketing automation. If you're going to market, and if you want to become the GOAT to market, you've got to have the right marketing automation system. And after over a decade using MailChimp, I'm so glad that I switched over to ActiveCampaign. ActiveCampaign really is the GOAT of marketing automation. Whether you're a B2B SaaS, a marketplace, a consumer app, or really anything in between, every kind of business needs a newsletter. At Startup Hype Man, we use newsletters as probably one of the top 2 drivers of content and lead generation. And from setup to send, every newsletter we've published has been a 10x easier experience since switching to ActiveCampaign. ActiveCampaign has tons of integrations, automations made simple, and I just want to touch on that point for a moment. What I'm able to do with ActiveCampaign is when someone books a sales meeting with us through our Calendly account, we have an automation set up where they get added to our CRM list, and the tag that they're a lead gets automatically added to their contact name, and that creates its own sequence to support the sales process. And setting that up was like chef's kiss level easy. On top of that, anytime I have an issue, the customer support is actually supportive. You get live chat in seconds. And if you really need help beyond a live chat, you can set up a one-on-one strategy call really at any time. I can tell you this with 100% certainty. I no longer feel restricted by my automation software. Now, even better, they've made their pricing even more affordable than before, with plans now starting at just $15 a month. Not only is there great pricing, but you can even get started on a free 2-week trial. Just hit the link in this episode description, and you can get started with ActiveCampaign. Back now to the conversation.
A founder gets, they submit a deck. You're like, okay, this looks good enough. You create your internal one page, or the person on your team creates the internal one pager. Then they have the meeting with you. What have you seen as like that, almost like negative delta then, from the point of you liked what you saw up front, and then now you've talked to them, and you're like, I don't know so much?
That's a really good question, and I think some of it is situation specific, but some things that would cause red flags. If you said something in your intake form and then what you're telling us on the call is different, blatantly different, and you're not addressing the difference, like things can change. You do have to play a bit of the game of like FOMO. I get that. But you got to think about what the balance is, and maybe you can practice with Raj ahead of time, or your other founder friends, of like what's the balance where, it's not obvious that you're really exaggerating, and we're like, well, because we are trying to figure out constantly how do we prioritize all the deals we're looking at. What are the ones that actually really are getting closer to closing, or if we want to lead to a term sheet versus not. Our process typically takes 60 days from our first team call to investing, which may seem long, but that's our process. It has done us very well. The one time we deviated from that was not great. It's important for us. And we haven't lost deals that we felt like we've lost because we couldn't pull the trigger fast enough. So it really is. And it's, if we're leading, that includes like developing a term sheet and just doing much more in-depth diligence on your data room and all your documents. Like if you're leading, there's a different level of depth and scrutiny you're going through with your legal team. But yeah, 60 days, and that's okay. And I think actually in this market, it's taking VCs a lot longer than that. But if you were raising money in 2021, it was like from 1 week to the next. And we're like, well, we missed that deal and it's okay, So each VC, I think, will have a different process, I'll tell you. But we track all of our metrics internally. So our goal is from the time you submit an intake form, we want to be able to get back to you within a week, whether we are going to schedule a first call with you or not. It's taking a little bit longer than that right now, but I think that we're getting kind of closer to that timeline. But then from that first call, right, to the investment decision is about 60 days.
So on that note, I think timing of a fundraise is a pretty key thing. What advice do you have for founders on how to structure the timeline? Like, when should they start? How long should a round be open? At what point does it start to look bad that the round is still open?
That's a really good question. Well, there's a lot of memes and jokes around what VCs do and like is everyone in Martha's Vineyard all summer, which I can assure you they're not, but I am going to go to the Apostle Islands and Lake Superior with my kids. No, but I would say that this is, for VCs that are investing that are like roll your sleeves up kind of investors like us, we're basically building startups like alongside of you. So we are wearing lots of hats and totally have a lot of empathy for what you're doing. But we also need to take some vacation. So I would say that the holidays are not a good time to raise. Like, don't expect between Christmas and, middle of December to middle of January, right? Like, people just need to take time with their family. And I do think that July and August can be slower, particularly August, because it just tends to be a time naturally we're like taking some time. So don't ever plan to close in January or in August, unless has anyone here successfully closed in those months? Like, it's not great. I don't know if you would concur, but I would just say calendar-wise.
Typically, people are out of office in August, and they're not yet up to speed by January. I've seen rounds start in January, but not close in January. Starting in January I think is fine,
but not closing.
Yeah.
So don't plan to start something right before the holidays and then have it close. In terms of timeline and how long is too long to keep something open, that's a good question. I think that the founders doing pre-marketing is always interesting. Like, I'm keeping you informed and keeping you updated. There's a startup out of Chicago that we met maybe 6 months ago, and they said, they weren't raising yet, can we add you to our investor communication? Every 2 weeks, I get an email. Here were our milestones. Here's where we got to. Here's what we learned. And I love it because I'm like seeing the cadence. I'm seeing how they think. I'm seeing how they pivot. It's a really good practice to be in anyway, because although it takes time, as soon as you start building a team and you close capital and you have a board, you're going to need to be doing that on a regular basis anyway. You have to communicate to your board and to your team to keep everyone growing. So it shows me that they're thinking operationally, so I really like that. transparent about what's working, what's not, shout outs for who's helping them. I mean, it's like really good. And now they're opening their round. So when they reached out and said, we're opening our round, can we talk next week? I'm like, yeah. Because you already filled out my intake form like 6 months ago. For the time, I'm like, why did you're not raising yet? Oh, do you want to be on our list? Sure, I was on the list. So they've done a good job of building the momentum. I don't read the email from top to bottom every 2 weeks, but I will skim it. Sometimes I'll read it. And then I know I have it, so I can refer back to it if I need to. So I think that that's really smart. So doing some of the pre-marketing is great. Having a newsletter is good. These are all tactics we use when we're raising a fund. We have a monthly newsletter that goes out every single month, right? Every single month. And sometimes we're like, are we going to be able to fill up this month? Yes, we can. Every single month, it's the same things. And it's what folks in our ecosystem want to see. Thought leadership, how we're thinking about market maps, what types of founders we're trying to attract, what types of events have we been at, where can you find us, like all that type of stuff. So, I mean, if a round is open more than 6 months, that's probably a red flag. If a round's open for more than 6 months and you haven't got a lean turn sheet, 90 days is probably more ideal and more typical. But I think in this market, I've seen them open up to 6 months to get a lead. It's just this is the kind of the market environment that we're in. I don't know if you're seeing anything different.
There's been some that have happened quicker, but it is generally, I mean, the general ratio is like they kind of say it's like, 100 meetings to get one yes. I would argue now it's like that's probably multiplied by like 2 or 3.
Yeah.
And it's like 200 meetings, 300 meetings to get a yes.
And it's taking more time.
Yeah.
Like in 2021, we would see some rounds be done in a month or even 2 weeks. But if it's 2 weeks, they already had the investors lined up. Like, don't kid yourself that they just like cold met all these investors, or they like came out of General Catalyst and started a company. So there was already a network in play there. I don't think we're seeing anything done now in like 2 weeks to a month, unless it was totally pre-baked. It is taking longer.
I got 3 more quick questions.
Yeah.
First one, why do a lot of investors not want to take the lead on a round?
Because they have to set terms.
And why is that scary? Or why is that
It's
something they don't
scary
want to do?
because, again, with information asymmetry, and sometimes you're looking at technologies or things that haven't really been done before, you're trying to take market information to determine the valuation of a company. You're trying to make sure the founders are diluted appropriately at that round, but not too much so that they don't have enough ownership and it sends a bad signal. You're really putting a stake in the ground around how much of a company you're going to own if the term sheet is signed, and that impacts your returns at exit. So it's scary because you're defining a lot of the dynamics around this company, and depending on how the terms are set, it's going to be attractive or not attractive to other investors you might bring in. Yeah. Does everyone know what setting the terms of the round means? No? So basically what it means is, so when you're raising your first priced round, someone's assigning a value to your company. So they might say at pre-seed, this company has an idea, it's a great idea, but no revenue. It's going to be a $5 million pre-money round. You're raising $1 million. So the post-money valuation is $6 million. And depending on the check they put in, they're going to own that percentage of the company. And your percentage, if say you owned 100%, is going to go down. And then every round, it's priced. Later on, it becomes more scary because like during the 2021 hype cycle, a lot of these Series A, B, and C companies were really overvalued relative to the revenue. They were being valued on potential revenue for the year and maybe contracts, maybe letters of intent or agreement, like not actual revenue. And if that revenue didn't materialize or takes longer, which a lot of times it does with startups, they didn't grow into the valuation, which could be 5x or 10x or depending on where you're at in the market. Later on, it's lower than that. Or 100x. It really depends where you are in the cycle. But if you didn't grow into that revenue or you didn't grow into those milestones, or if you're a biotech company, you didn't get GRAS approval or FDA approval and you're still waiting, you're having what's called a recap, which means either your existing investors or someone else is coming in and maybe valuing you lower where you were valued, and then everyone gets diluted even more. So it can be scary to be pricing around when you're at the later stage, because if you get it wrong, it has very existential implications for the business.
Yeah.
Yeah.
That's how a lot of companies get tanked ultimately. But the idea of the what was the phrase? The terms. Was that was what you said when you asked the question? Was it terms?
Mm-hmm, terms.
That's like when you watch Shark Tank, the first thing they do when they walk on the carpet is they're like, we're raising $200,000 for 20% equity in our company. They're saying our company's valued 20 times 5. So we're valued at $1 million is what they're saying. That's the idea.
Which, by the way, I mean, the sharks get really good terms. And I've heard that they
yeah.
don't all go, those deals don't usually all happen after the show.
Yeah.
So don't like benchmark yourself to what's happening in Shark Tank.
Yeah,
But
they always get
generally
crazy equity that's
Yes.
pitched on TV. But
Yeah.
most of the Shark Tank deals, or if not
don't
most,
have it,
a lot
is
of
what I've
them,
heard.
it's a handshake on screen, and then they actually go through like a negotiation process afterwards.
Yeah.
Some of them happen, some of them don't. The ones that do happen are not usually the terms that they set on TV. It's theater.
Yes. Yes.
Take it as that. Take it as theater you can learn from, not
Yeah.
education that happens to have theater in it.
Yes.
What is the top, best, number one trait you like to see in a founder?
I really like to see when they can show examples of resilience throughout their life, which could be anything. It really could be anything, but the reason that you want to see that resilience, like you're knocked down and you got back up, you're knocked down and you got back up, you're knocked down and you got back up, because that's exactly what's going to happen when you're a founder. It's like you're swimming and the waves are really high and you just keep getting knocked back and you're like, I'm going to figure out how to get to the shore, you know? So you have to have that tenacity. And I think a real belief in your company. But the other thing I really like to hear is that quote back to my LinkedIn, which is listening enough to be changed, because that has to be coupled with the humility to know when you need to pivot. Because if you're like singularly focused on like, this is the only way to do this thing, it's going to be really hard. If you're singularly focused on this is a problem I want to solve, but I can be flexible at how I get there depending on what I learn along the way, those are the founders that really succeed. Like we were talking about the company you're working for that started as a dating app, but now they service frontline workers. So like, you know, they're trying to solve a problem and then pivoted and they were Series C. So it's that relentless.
It's not dating for frontline workers.
It's not dating for frontline workers. No. Although that would be. Yeah.
Okay. And just to that, one thing I'll add real quick is a lot of the founders that I work with, they don't have like a Harvard MBA. And they'll have this moment of like, oh no, like what do I have? Like, there are these other people who are pitching investors who have the big degree. I don't have that. Like, why would they listen to me? And the conversation we always have is like, I mean, sure, you'll have a network if you have the Harvard MBA, whatever, that has its own benefits to it. But you personally have a story as well. And you have to be able to look at the entire scope of your life to find what's the common thread line that got you to here. And it can be the resilience, the overcoming things along the way. But, you know, like, for example, if you have an app that is about better workplace collaboration, dial it back to, like, what's the essence of that? Community building. When can you show a track record throughout your life that like community building is the thing you have always been able to do? And that could even be like when I was 11 years old, I rallied people for my local youth group or church group. Like if you can show someone that like your brain only knows how to work around this like domain, that is so, you can deny this or corroborate it, but that becomes so attractive to someone else who's thinking about, is this person worth investing in or not? And my thesis has always been, yes, if they can see that like this is how you operate by default, it's part of your DNA. If they took a blood sample, in this instance, community building would come out in one of the cells or a lot of the cells. Like that's what helps someone feel good about you, especially if you don't have that degree.
Yeah, and it's also, is this a problem you really care about solving and why? It doesn't have to be you're addressing climate change. It could be, I really want to create a place for people to connect, and first you thought it was dating, and then you thought it was something else. Like, but it's like that you really, for some reason, you care about that. You know, like we invested in a founder. Actually, we should look at the degrees of our founders because I actually don't even know the link to like Ivy League stuff. It's interesting, but we always listen to the personal stories. And one of our founders has, basically they've built a software that scrapes the internet for lots of data every day to predict supply chain disruptions, which is really interesting for us, across 140 agricultural commodities. And this founder has done lots of things in his career. He was in consulting, and then he built this deep tech startup. But really, for him, the aha moment went back to when he was like 19 or 20, and he needed to make some money for his family. He was living on the border, so he started importing avocados. And there were a lot of uncertainties around that supply chain. And that is something that had stuck with him for like 15 or 20 years. And after he went through consulting and he was working on enterprise, applying new SaaS solutions to supply chain issues they were having and doing technological transformation. Then he was working on this deep tech startup. And then he just kept going back to this problem he had when he was an avocado importer at 19 or 20 years old. And he's like, oh, actually enterprise transformation. Okay, a lot of big companies need to figure their supply chains out now in a different way they never did. Oh, and I've also done this deep tech, and we were building on AI ML models. I can put that together to solve this issue that's been really bothering me since I was living as a new immigrant on the border and had to help my family figure out how to make some money, and it's like I couldn't figure out the consistency of the avocado supply. So I actually don't even know what degrees that founder have. So it's a really good point. I should try to understand that. But I understand his life experience. And so the story was not about going to, getting all the pedigrees. It was about what experience he had in his life and what experience he had in his professional life that then brought all personal and professional kind of together. And that is definitely a through line in the founders we've invested in that we hear over and over again. And many of our founders come to their companies later in life, actually. And actually, I read some stat, I can't remember exactly what it is, but something like the most successful companies are founded when founders are over 45 years old. So now that I'm reflecting on this, and I hadn't before, a lot of our founders have these stories of their life history and how the personal experiences they had and the professional experiences end up leading them to create something new.
I have a feeling part of that. I'm 35, but if you take me today versus when I was 25, my tolerance for bullshit is so much lower now than it was 10 years ago. Yeah. And I think that's part of what age plays a role in.
Life experience.
You're just you put up with less crap over time, and then that's what makes you a better decision maker ultimately.
Yeah.
Last question here. We're going to take this audio and I'm going to end up pushing it into the Startup Hype Man podcast called The Goat to Market Show. Go out and subscribe to that on Spotify, Apple Podcasts, and all YouTube, all that stuff. Anyways, the final question I always ask on my podcast is fill in the blank. Entrepreneurship is blank.
Inspiring.
Say more on that.
Oh, okay. I thought it was just one word.
Well, yes, it is, but now I want you to elaborate.
Okay. It's so inspiring. I mean, you just meet people every day who are so passionate about solving problems that are so important and so big, and it's how we relate to each other in our everyday lives, and it's big picture futuristic thinking, and it's just every day. I'm so inspired always by the stories of the founders I meet and their just tenacity to go after and get it done. I love the doers, and these are the doers,
Love it. Entrepreneurship is inspiring. I have held you a few minutes past your cutoff time, so I apologize. But everybody, we've brought her on like Beyonce. Let's send her off like Beyonce. Ladies and gentlemen, give a big thank you to the one, the only, Shayna Harris!
Thank all of you.
That'll put a bow on this one. Before we head out of here, a couple quick housekeeping items. Number one, did you like what you heard? Well, give us a subscribe and a follow. Maybe share it with one friend who you think would find this valuable. Number two, remember that Ask Me Anything I told you about at the end of the episode? That goes down exclusively inside of Goat to Market Club, our online founder and startup community, and you can access it for free. And your membership is 100% free at startuphypeman.com/GTM-club. Number three, need pitch help? Startup Hype Man is your man. Whether it's a fundraising narrative or a go-to-market or category narrative, we've got you covered to make sure you have messaging that doesn't help you just go to market, but of course what? Helps you become the GOAT to market. All right, we will see you next week here on the Goat to Market Show. Thank you for listening. And remember, why be a unicorn when you can be the GOAT?